Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm pleased to have Jeff Gardner with me today. Jeff spent nearly 29 years at Bridgewater Associates, one of the world's largest hedge funds. He started in research and eventually became partner and head of the Portfolio Strategist Group before he left at the end of 2023. Jeff, welcome.
Thank you, Alex. Very happy to be here.
Let's start with your background. What would you say initially sparked your interest in investing and the economy?
Well, I was originally an engineer studying engineering. I went to MIT, and I really thought that that's what I wanted to do. But after I spent a little bit of time there, one of the things I noticed was that a lot of the people who had graduated and came back and visited after graduation had moved out of engineering into other areas. And so whether that be becoming lawyers or moving into sales or management, in essence, a lot of them really didn't stay engineers for very long. So what that said to me is maybe I should go check out other areas here, go check out the business school. And as I did that, I found what I really, really enjoyed was finance and finance classes. And then secondly, economics. And so economics was one of the things I enjoyed the most about my time there. And I ended up doing a dual degree then in engineering as well as finance with a concentration in economics.
So you studied mechanical engineering and management science at MIT. And I think you got a master's as well. So with that background and your experience in the markets for 3 decades, do you view investing more as a science or an art? And has this perspective evolved over time?
I would probably say both. I think there's elements of both involved in it. It's like science in the sense of you're studying a very large systems and how those systems operate over time. There's rules that lead to cause-effect relationships that you can really study. And I think both a quantitative and a disciplined approach to studying those can be very beneficial to help you in being a better investor. With that said, I'd say, for those of you that are familiar with physics, it's more like quantum mechanics than it would be like classical physics, I think, in the sense that markets and economies are really more probabilistic in terms of when you look forward. There's various outcomes and there's likelihoods of a lot of those different outcomes occurring, as opposed to this happens and so this will definitely occur. It's much less that. It's much more, it's likely that this set of things may occur or this set of things may occur. Multiple outcomes are always possible. And you have to really think those probabilities through and invest accordingly. On the art side, though, Alex, I think one of the interesting pieces just to say is, at the end of the day, economies and markets are just people. And it's the reactions of people. And so I think they really reflect people in many ways in terms of the way that they work. And so one example of that, I guess my observation would be that over the time that I've been involved in markets to me are very much things that have fads, just like other industries, like the fashion industry. Maybe that's a little bit controversial to people in the investment industry, but I really do think that, there's always like the hot topic of what people are talking about or the hot new thing that people are looking at. And that in many senses, that kind of overshadows the slow and steady approach that ultimately, I think, wins much more often for people in terms of investing success. So one additional thing I might just say to that point is I think that George Soros's theory of reflexivity is a good reflection of that. So his idea was basically that investors don't just base their decisions upon reality. They base their decisions upon their perception of reality. And so the fact that they have a perception of reality that may not be the same as true reality, that still has an impact on the way that conditions evolve and in effect change reality through that perception. And that in many senses, it also tends to be a self-reinforcing cycle where those perceptions lead to changes in prices. And then the prices and those perceptions actually lead to changes in conditions, which further reinforce the move in that same direction. I think in many senses, that's kind of where bubbles come from, is that type of behavior that we often see in markets. So I believe there's really both of those things. You don't want to have just one or the other approach. I think you can think about positive aspects to the markets from both sides and as well as negative aspects to the markets from both sides.
And I think what's really interesting about what you just said is that on the surface, it seems like science/fundamentals should win out over time. But the part that I think that you just touched on that I think is really insightful is that oftentimes the perception can be self-reinforcing and change the fundamentals. And the interaction between those two is part of what makes investing and trying to predict where markets are going to go so challenging.
Absolutely.
So you spent 29 years at Bridgewater. How would you say your time there shaped who you are as an investor?
Well, I mean, first I would just say that working with Bridgewater's founder, Ray Dalio, and my colleagues at Bridgewater, I learned so much from them over the time that I spent there. And it's hard to summarize that into just a handful of things, but I'll try maybe to relate 4 points that I took away and continue to be significant impact on how I think about the world. So the first point is that there is a really beautiful thing about markets in that over the long term, markets offer long-term positive expected returns to everybody who invests. And so this is really a core tenet that derives from capitalism itself. So if the capitalist system works, you can probably expect that those returns will be there. At the end of the day, this, I think, is the most important thing for any investor to realize, which is being invested and holding those investments over the long term is the key thing you really want to focus on. And in particular, it's why asset allocation is such an important element of how you think about your investing strategy. The second thing I would just highlight, though, is that Bridgewater itself is really focused on active management. And more than anything, what you learn from trying to beat the markets is just how hard it is to do that. What's actually required to outperform is an enormous amount of effort. And even with that, your edge can be very slim and you will oftentimes underperform. So that active management itself, in many senses is a very difficult thing to do. And in general, you want to be very careful about how much you might expect to beat markets over time. A third piece would be, at the end of the day, investing is really all about risk. In other words, there's the old adage, you take risk to make returns. That is absolutely the kind of an underlying element here to how markets work. So investing well, what that really says is investing well is all about managing risk. And that is an endemic part of your process. You have to be thinking about risk management as you think about how you actually set up your investments. And so this is where, in my mind, diversification really comes into the picture. Diversification is an extremely powerful tool if you're able to take effective utilization of it. And it really should be a core part of how anybody thinks about entering into the markets. And then last but not least, Alex, I would just say one of the things that was very interesting and an eye-opening point for me about how this is often not understood by people. But at the end of the day, markets are entirely a forward-looking exercise. In other words, markets discount what the future looks like or future conditions. So today's price is not really about what's happened in the past. It's about what you expect the future to look like. And what that means then is what will drive prices is going to be how conditions come in relative to what was already priced into those markets. And so when you look at how companies respond when they announce earnings, you can really think about this as the classic thing that happens here is it's not whether the company grew, whether earnings went up or went down. It's how those evolved relative to what people expected that matter. So one interesting example, if you go back to just the last quarter and NVIDIA announcing its earnings, they had a phenomenal quarter, enormous growth in revenues, enormous growth in profits, and yet their stock price sold off after they announced those earnings. And the reason being, of course, people were hoping for something even a bit better than that. And so the stock already captured an expectation of extremely good performance, and even extremely good performance wasn't enough to drive that price up.
It's interesting. The 4 points you just made. The first one, I think most people would intuitively agree with. Compounding works over time. You get paid to take risk, so stay in the markets. The final three, many of those points can be very counterintuitive. Risk is just in my experience, such a hard thing to understand because it's the thing you can't see most of the time. And so we'll talk about that. Diversification, it's really interesting. Being an advisor for 25 years, people value diversification when markets go down, and when they go up, it seems like perpetually, the value of diversification can really become much less emphasized. And I think today is one of those periods. And then predicting the future and being, having alpha or outperformance it's so challenging because there is this, at least my experience is that there's so much overconfidence in the ability to look into the future and guess what's going to happen. And this perspective of what is the market discounting, that's hard to really understand. So a lot of what you just described can be very counterintuitive, even though when you say it, it sounds very straightforward.
I think that's absolutely right, Alex. And so, probably worth talking some more about that. But this idea of what do you not know about the future, I think it's a really important thing for anybody to wrestle with, especially if you are hoping to actually outperform the markets. It's really a key thing to understand. It also goes to how much you should really make changes to your portfolio. How much do you really know about what the future looks like versus starting from a point of just saying, I have a very good long-term asset allocation I think will serve me well across cycles, across time, across lots of changes and conditions that I might face. That's probably, to me, I think where you want to start as an investor. And then from that platform of that base, you can actually then say, how do I want to make changes relative to that? But also, how much should I change it is an important thing to consider as well.
So throughout your career, you've met many sophisticated investors. What would you say distinguishes their investment approaches from those of the average investor? And maybe you touched on some of those just now.
Yeah, I think I probably hit on some of those already, is understanding those points. But I think that number one would be a focus on process. So what I see is they regularly come back and discuss, review the approach that they take. They talk about alternatives, consider changes, et cetera. But having that formal process of really thinking that through, I think, is an important way to actually manage your investing strategy over time. It's something that you should pay attention to. What process should I actually follow? A second key point that does relate to what I said before is really the focus on asset allocation, realizing that that's the most important foundation to the portfolio. Focus on risk management would also be in there. And when it comes to risk management, I would say a lot of those, what you would see amongst those kinds of investors would be looking at lots of different scenarios, not just focusing on what they think is most likely to happen, but really saying what are the range around that could happen, and planning for those is an important part of actually that preparation. A few additional things might be that generally they try to seek outside advice, and probably a lot of different types of advice. So looking for additional ideas, triangulation from outside advisors is an important part of that. They have more tools to manage what they're trying to do, whether that be access to different kinds of institutions, as well as just different kinds of instruments. Most investors probably don't use derivatives, but derivatives can be really used to help manage risk or achieve specific outcomes that you're trying to accomplish. And then last but not least, it's just the amount of work that they put in. Obviously, when it's something that your career is focused on, you put an awful lot of work into every single decision that you make. And I think that's something that they have the luxury of doing. And in some senses, though, sometimes maybe that also holds them back.
One thing that I believe is related to what you just described is that the younger investors can be in some ways more confident than investors who are much more experienced and have been through a lot of different cycles and can tend to be less diversified. And so you can think of like the spectrum. On one end, if you're really confident about what you think the future holds, you see less value in diversification. Whereas on the other end, if you've been surprised a lot over your career, you start to appreciate that the future is difficult to predict, and therefore you do a lot more hedging and more diversification. Is that how you think about it?
It also goes to a general kind of almost meme of people think about how you actually invest and what you should do, which is you pick that one stock and you really pick the best stock, and it ends up being a phenomenal trade. And that, as I was saying before, even for people who spend all of their time focusing on this, that's a really hard thing to do. And that in many senses, what really behooves you much better is to actually hold a good diversified portfolio that has both a range of assets as well as diversification within those assets, and that you take advantage of that long-term return that markets offer. And also the other key part of that, which I didn't hit before, is compounding. Compounding is a really powerful effect that you can use over long periods of time, which is also why you want to start early as you can as an investor. Put some money in, even if it's not a huge amount. The longer you're in markets, the more likely you really get an enormous benefit from compounding.
So if we take it one notch up among the elite investors you've encountered, what rare qualities or exceptional traits do you feel set them apart from even the great investors, and meaning those that you consider to be in a league of their own?
There's a number of things I could think of here, so maybe I'll hit on some of those. I'm happy to talk a little bit more about that. But probably the first one is they're willing to be different than the crowd, and so I think people underestimate how difficult that actually is to stand out and to really do something that others don't see or don't believe. That is a very unique kind of skill, a very unique kind of person. I think that actually is required to be able to do that. And somewhat hand in hand with that is the idea that they're often skeptical of accepted wisdom. And so there's a lot of kind of basic tenets out there that many people just take as a given. I would say the best investors challenge even those and really make sure that they understand what assumptions am I making by believing in that thing, and then considering, are there times where those assumptions may not prove true? Because that can often identify some of the most interesting opportunities that might exist, especially for an active manager. A third thing would be changing your mind and admitting you're wrong. That is very hard for almost everybody. And I think the ability to do that and to do that quickly and to make adjustments is actually something that really distinguishes some of the best investors that I've ever seen. They also think about a lot of scenarios that may occur, and they don't just prepare for the most likely scenario. They prepare for surprises and things that are well outside of what they might actually expect to be the most likely thing, and have a game plan for what to do if those things actually occur. And one of the beginning point of that is diversification itself. That's really why you have diversification, is because even though you might expect one thing, at the end of the day, getting something very different than that can lead to enormous price impacts. In fact, surprises are the big thing that really drive big movements in markets. So maybe to finish that topic up, Alex, I'd say managing the size of their investments, having a deep understanding of this idea of making probabilistic decisions, and recognizing that you're going to be wrong on some of those, have a good plan that's well suited to your own situation. And then lastly, I'd say focusing on managing stakeholders is a really important as well. Make sure there's alignment about everybody who really is dependent upon those investments and the outcomes that they produce.
One other attribute that I've witnessed talking to a lot of great investors is there's much less emotion in their decision-making process and more process in the way they think about investing. And what you just described is a lot on the process side, but I've also noticed that they're much less likely to have knee-jerk reactions to market gyrations.
I think that's a very important one too. That I totally agree.
Shifting to mistakes, we've all made mistakes. What would you say are the most significant mistakes you've observed investors make, regardless of their experience level? And how do you think these errors differ between the experts and the novices?
Yeah, it's interesting. I think in many ways that I don't know that there's that big of a difference between experts and novices with regards to a lot of mistakes. We're all sort of prone to the same issues and instincts, and so that's that. I'd probably start there. Not admitting you're wrong is one of those things, and as an active manager, I can tell you, like, when you build an investment thesis for why something's going to do well or do poorly, you work really hard on that. You put so much time into it. It can be very hard to acknowledge that that is actually not correct. And so I think that's a really important one, is being too wed to your own ideas and not willing to adjust as circumstances change. That idea of fads would be another one that I would say you should be skeptical of things that are the hot topic of the day. And there's kind of two reasons for that, which is, number one, I think people are quite prone to that kind of behavior and thinking that I have to be in this thing or else I'm going to miss out. But then secondly, it's also that point about markets discount the future. And so markets really do understand a lot of things. And if you're looking at a particular stock or a particular asset, it's pretty likely that the thing you're thinking about is already incorporated in the price. So you really have to understand, is this something that others don't recognize, to really say, I've got an opportunity here that maybe is something that's unique and could be a real driver of markets that's not appreciated. I think, another big one, which is everybody is prone to this just because it's kind of the most available thing. But in general, people rely way too much on returns to judge future performance. So backward looking returns tell you only about what happened. They don't tell you about what the future will be, but there's a very strong tendency to extrapolate that forward. And I think that's a really hard thing to get away from, even for people who are experts. Last but not least, I think, I would think about the idea of your risk tolerance. So you mentioned this already, Alex, but I have seen so many times when people invest in something and say, well, I'm holding this for diversification purposes, but then they really can't tolerate losing money in that, or it goes on for too long, and they get rid of it oftentimes right before it actually would have really benefited them to hold on to it. And so you have to really deeply understand, what do I expect from these things? And, what does a bad period look like? And then try to step away from that. And as you said, try not to be too emotional about the actual results you experience versus having confidence in that longer term plan that you've built.
And a common thread in everything you just talked about is time horizon. And what I mean by that is, if you have you have to figure out what the time horizon is. Was your idea correct or incorrect? And the big question is, over what time period? Is it 1 year, 3 years, 5 years, 10 years? When something is underperforming, over what time period are you looking at it? And my experience is, most people have a much shorter time frame than the science side of investing would suggest you should have. Do you agree with that?
Absolutely. Yes. That idea of a long-term positive expected return, it's actually a very long time for you to expect that, 20 years plus that you would expect that to be true. And so having something that underperforms for 10 years does not necessarily argue that that's actually a bad thing or a bad choice.
Right, because if you have, let's say, 10 years of underperformance in everywhere outside of the investment world, you would look at that and say, okay, that's a good predictor that the next 10 years are going to be bad. But it could almost be the opposite in this environment. So it is very counterintuitive in that way. And 10 years is a very long time. Everywhere else in investing, it's a relatively short time.
Absolutely.
So one of the things you and I have discussed in the past is the challenges of uncertainty in investing, particularly the risks with not knowing. Could you elaborate on this a little bit more?
Yeah, absolutely. I think in many ways, this is a really important thing for people to reflect on and think about. Because investing is making decisions about the future, it's really important to really understand, how much do you actually know about the future? And I think the reality is, even for people who are focused on markets every day and spend all of their time looking at it, what you know is much less than what you don't know. And there are so many things that can happen that can get in the way of the thing that you're looking at playing out, that you really have to be prepared for that fact. So it goes a little bit or flies a little bit in the face of the thing you see every day when people think about markets, though, Alex. If you turn on some of these financial channels, or you listen to people talking about markets, what they're always talking about is what they know. Here's what I think is going to happen, et cetera. What they don't talk about, and I think what probably distinguishes the truly wisest people from those who maybe are less wise, would be to talk about, how uncertain the picture really is. And there are times probably where that uncertainty is higher, and there's times where that uncertainty is probably lower. But at the same time, there's always a big degree of uncertainty. And so at the end of the day, you're betting on outcomes. And the way I might describe this is, for a really good active manager, if they're betting on those outcomes, what's a good edge look like? They're probably right something like a little bit over 50% of the time, maybe 55% of the time. And so that is actually a good edge, and you will make money in markets on that over time if you can stay in the markets and get lots of opportunities. But what that also tells you is, there's an enormous chance that you're wrong in any one position that you take. There's a very large chance, 45% at least, that you get that wrong. And so a big part of investing is dealing with that fact that there's so much you don't know that will drive what the outcomes are relative to what you do know. And that's where, as you and I know, are big believers in this, but it comes back to this idea that diversification is really your best tool to help you manage against that, because there is so much that's going to occur that you don't expect, that surprises you. And when you look at the big movements of markets, let's say the stock markets, the big crashes we've seen in the last 20 plus years, you have the tech bubble, the financial crisis, COVID. At the end of the day, there was one set of conditions discounted and things turned out extremely different from that. That big difference in how things actually played out relative to what the markets anticipated is what drove really large price movements. And so that's what it looks like. That's what it always looks like. That's what's going to cause big movements to occur. And of course, by their very nature, almost it's by definition, they're things that you don't expect that will actually come along and really hit you hard.
Let's dig into diversification a little bit more. How do you approach diversification in terms of asset allocation, US versus non-US, as well as considerations related to China and other places?
As you can probably gather from what I've said already, I think the starting point would be have a long-term view on asset allocation, really don't meddle with it very much. I would say though, maybe when you're looking at your portfolio, it's worth noticing if anything begins to kind of drift out of what you would normally think is how conditions or allocations should look. So the thing that I would just highlight right now, Alex, which is particularly interesting, and I think every investor should really think hard about this particular point, which is that the US has now done so exceptionally well for quite a long period of time that what we actually see when you look at something like a global stock market index, those global stock market indices are just based on the value of the market itself. And so the US has outperformed so much, it has become a really large part of even a global stock market index. And in particular, what I mean by that is I'll just kind of take an example of the FTSE all cap index, which is a global index of all countries. And so when you look at the US share of that, it is today 65% of that overall stock market. And as a second thing to consider here, what's the next biggest country? The next biggest country after the US at 65% is Japan, and it's only 5.5%. So we're talking about, something like almost 13 times the size of the next biggest market when you think about that from a country perspective. Now, there are, of course, reasons why that's happened and why the US has done so well. Certainly, it dominates in tech, and those tech companies have really been a big driver of outcomes. But even within the US stock market, not only is it a very large part of the global stock market, it's also that we see a very large concentration in a handful of companies, in particular, those largest tech companies in general, they've come to be known by the name the Mag 7. And something like 20 companies make up about 50% of the US stock market. So you have a very large amount of concentration today, which is very exceptional. The reason I'd highlight that, what really kind of brings back memories for me is in studying markets, one of the other times you've seen that is what we saw in Japan in the late 80s. So Japan at that time, of course, was always a much smaller economy than the United States, but its share of the global stock market was something like about 50% at the peak of the bubble in Japan in the 1980s. And of course, that eventually popped, and now you see it's only 5.5% of the total stock market. So I'm not predicting anything like that for the US. I'm not saying you shouldn't have the US, but I do think you might say to yourself, is that more concentration than I really feel I'm comfortable with, and is more concentration that is consistent with a good diversified portfolio? I think that's worth asking the question and thinking about what you might do as an alternative. So maybe I'll pause there, Alex, but we could also talk a little bit about what you might do in the face of that concentration as well.
But let me ask you about the US versus non-US. So when you look at it, trying to be objective, you can say, look, these are the best companies in the world. There's no sign of them slowing down. Their gap is only increasing. Why would you not want to overweight that market relative to others that just don't look as attractive? How should somebody think about that?
Yeah. Well, I think the first point I would say is even if you were just holding market cap, I think you're already overweight. You're overweight relative to what is probably reasonable over time. Because if you look at the US economy is something like about 20% of the world economy. It's not 65% of the world economy. And so there's a very large share of the global stock market in the US relative to the actual driver of the world economy that the US represents. That's kind of one simple point of comparison. I do think there's reasons to say that the US probably will have a larger market cap, though, because more companies in the United States are public companies than there are in other countries. So that argues for there being somewhat higher kind of allocation to that. You also have more companies in the leading edge of technology, which the US has really excelled at this. And that also probably argues for something like a higher weight. So, I'm not necessarily arguing that you cut that all the way back to something like the GDP weight of the United States. I do think you could say, though, what you do, it is worth saying, what level am I comfortable with in terms of this? So I'll just throw out a number and we could talk about that, but maybe something like 50% of your stock exposure in the US, as opposed to allowing it to be 2/3 of your overall stock exposure. And then within the US stock market, something you might consider is that part of the reason the US is where it is because the valuations are really high on those tech companies. It's implying a really strong continued outperformance, not just that there has been outperformance, but there will continue to be that outperformance. And so when you think about that, that's a lot like what the tech bubble looked like in the early 2000s too. And you're discounting a lot of companies that weren't making any money that were actually going to basically come to dominate the world. And of course, a few of them did, but a lot of them failed. And so that's partly why you want to diversify and not become overly concentrated in these, even though by no means do I think you want to go to the idea that you wouldn't have any exposure to them. But what that could also argue is it may be worth considering things like adding, in addition to holding broad market exposure, adding some exposure to value stocks, or adding some exposure to the mid cap and small cap stocks within the index to help kind of bring a little bit more balance back to your exposure, even as you continue to have a large allocation to those companies that have done very well here.
So you could see, kind of bring it back to where our conversation started. You could see a clash between science and art, right? So science and core investing principles suggest diversification works over time. The art side, and maybe in this case more of a fad of, look at, these are the best companies of the world. They're growing fast. The outlook looks tremendous. We want to overweight this, and that feeds on itself. And not to mention that when 2/3 of the index is US, any money that goes into passive investing, ETFs and index funds, 2/3 of that globally goes into the US, and it just keeps feeding that. And yeah, it reinforces it and keeps this fad going longer and longer and longer. And so that's a challenging set of circumstances to deal with in practice.
Absolutely. And I think a couple other things, which would be international stocks are kind of hard to love these days, given the way that they've performed. But in many senses, what they offer is a much lower price for even companies that might be quite similar to what the US versions are. And so, in some sense, having a little bit more exposure to international stocks, I think can be another way to help diversify yourself a little bit. And then probably even more importantly, though, when you look at the bond market, for quite a while there, bonds offered almost nothing. And it was very hard to want to have any exposure to them at all. That's not the case anymore. Bond yields have come up. In fact, they've actually risen by 1% in just the last couple of months. And so when you look at bonds today, in many senses, there's reason to believe that the forward-looking returns of U.S. bonds are going to be better than what the returns might be of those large cap stocks. And so you get about 5% on bonds because the yield, of course, tells you about its expected return. In many senses, when you look at companies at the kind of valuations we see in the United States, in the future, they would often offer much lower returns, potentially zero or only slightly positive returns over the next 10 years. Now, I'm not making an argument at all about the next 2 years. So it's important to say, I'm not saying this is going to happen anytime, in a very short-term horizon. But over a 10-year horizon, you probably, that's where those kind of valuation metrics tend to be more valuable. And it does look likely that stocks in the U.S. probably won't continue to do as well on a long-term sense here as they have done recently. So bonds, and I think inflation protection, we'll probably talk about the topic of inflation, but I would definitely argue that people should be thinking about having some inflation protection in their portfolio in addition to diversifying their stock exposure.
So on the topic of diversification, we talked about the US, non-US. How do you think about other economies, perhaps China being one, where there is a negative trend, the news is bad, the outlook is challenging, there's other concerns. How do you think about those asset classes within a diversification framework when they're going through a challenging market environment?
Yeah, I think it kind of goes to the point that, yes, the things that you just mentioned, those are already in the price. And so the next thing that happens is really what matters. And I think, you look at China, there could easily go both ways. You could have it go where things actually continue to decline and get worse, or who knows? The government may announce a massive new program to stimulate the economy and begin to turn things around. And the markets often, react an awful lot to those announcements of a change in policy. Fed policy is a classic example of that. Fed policy in 2009, when they really decided they were going to massively try to reflate the stock market and ease monetary policy, had an enormous impact on stocks at that point. So you just don't know how that's going to play out. When you think about China, too, I think it's worth considering. If you looked at non-U.S. stocks and you just sort of say, if I did an allocation to non-U.S. stocks, what am I getting? Well, you're going to get about 40% Europe. You're going to get about 27%, call it Pacific. You're going to get about 27% emerging markets. And then a handful of other things like Canada, Mexico, and North America, et cetera. So China, though, of that total non-U.S. stock markets would be about 8%. And so if non-US is 50% of your portfolio, China's going to be only 4% of your total portfolio. You're not very exposed to it. And having some exposure to it at that level is probably a pretty reasonable thing, especially given that point that it's very hard to know exactly how things will play out.
So far, we've talked about public markets. What are your thoughts on private markets as compared to public markets regarding both the efficiency of those markets and any long-term perspectives you'd like to share?
Private markets and their development over the last probably 15, 20 years especially has been really one of the things I've been most interested in following as that's actually occurred. In general, I'm a big believer that more options are generally better. And so I think that's a really positive development. And it offers things that are unique and different and that you can't necessarily get in the purely public markets. So, for example, real estate is one of those things that's pretty hard to get exposure to within the classic markets in any significant way. I think they're a real opportunity, and people should consider them as part of their asset allocation. At the same time, though, when you step into those, I think there's some important caveats that you have to keep in mind, which is, number one, they're less transparent, and you're not going to know as much about what's actually going in. They're probably a bit more concentrated than your typical kind of public market indices are going to be. They're active managed, which almost all of them are going to be active managed, which means the costs are higher. So oftentimes there's going to be a fixed fee, and then in many cases also a performance fee on top of that. Returns in areas have been pretty good, but you also should realize, this raises the question that if return and risk are very much related, the risks are probably higher than what we've maybe seen over the last period, especially last decade, because it's generally been a pretty good period for markets and for those private assets. And so that probably underweights some of the risks that they might represent on a going forward basis. I would also say you should expect to get higher returns. People go into them looking for higher returns. You should expect to get and demand higher returns from those because you're giving up liquidity, and liquidity is a big deal. So at the end of the day, liquidity is the ability to change your mind and actually access that cash, as your own circumstances change. So, Alex, one of the things, I'm sure you've seen this as well, but in the financial crisis, for example, some very large institutions that people thought of as being extremely long-term focused, they were forced to change their asset allocation and sell things during the financial crisis because they'd gotten to be too illiquid relative to what their demands on their funds actually were. So, even for people who have this kind of very long-term orientation and think they can handle it, things can change very quickly and it might surprise you. So you really should be careful about illiquidity as well. And then, maybe one of the positives of that, though, at the same time, is I think in many senses, it doesn't allow you to stare at it every day and watch every single tick of the markets, which, we're kind of prone to do that in many ways. That the longer term, you're almost forced into a longer term focus, which I think actually to some degree is a benefit for those kind of assets. So, those are some of the things I think about. But, at the end of the day, what I personally think is pretty valuable about them is the opportunity for unique return streams that can be diversifying. And, for taxable investors, potentially offer better tax treatment than you might get with public market investing. I think that's also something that I really look for. So I am generally looking for things that are unique return streams that are diversifying to what I already have, provide some better tax treatment, and then over time are going to behave in ways that are different than what I already have through my public market portfolio.
Earlier, you talked about how it is difficult to outperform in public markets, and maybe somebody who has a 55% success rate, that's on the higher end of the range. Do you feel that is different within private markets because perhaps they're less efficient than public markets?
Private markets continue to evolve, and there's always like new niches that where you probably have not a lot of competition. I'd say in the broad public market or broad private markets, though, what you really have today is a ton of money has flowed into those, and a lot of managers have grown up. So I would think that it's harder today to actually outperform in those areas than it would have been historically, especially like the big categories of private investments, like private equity, potentially credit. I think that that's also an interesting area. In general, my guess would be the really large ones are probably not the really large funds, really large managers are going to deliver you more beta than active management returns, and that the opportunities are probably going to exist in some of the smaller areas as opposed to those big areas. I don't know if you agree with that, Alex, but
Yeah, I think that makes sense. I mean, if you just think about it, you have markets that become more mature, more followed, more invested, that over time should all else being equal should become more efficient, meaning harder to outperform. And public markets that happened some time ago and continues to happen. Private markets, it took a little bit longer to catch up. And because of all the money flow you've seen there and new strategies that pop up and the democratization to make it more widely available, you could see why that would be the case. But still, you're going to have more pockets probably within private markets that offer unique returns, offer the opportunity to outperform because there's less competition. It's more complex. It's not as easy to access than similarly in public markets.
I think that's right. And then I'd also say, one thing that I didn't mention before was, the private credit universe is very interesting, and I think that's also to me a reflection of regulatory change that came in the aftermath of the financial crisis, which really caused the banks to have to hold a lot less assets and run at a lot less leverage. And so in essence, the private sector stepped into that void, and there's even if there's leverage in private credit funds, it might be, call it 4 or 5 times would be a lot kind of within that area. The banks were running at 30 times. And so you had really large institutions with enormous balance sheets. Today, you're talking about, that's being absorbed by many, many different entities at smaller size and much less leverage. Those are examples of where I do think that there's opportunities that exist in the private universe that the public markets really you don't have a lot of access to.
And you touched on real estate earlier, but that is a very fragmented market as well. There's different layers of players. You have the allocators, you have the operators, you have the management companies. It's very localized. So you could see it would make sense that there would be pockets of inefficiency within the real estate market that potential managers could take advantage of.
Absolutely. I think that's absolutely right.
Do you have any additional advice for the average investor looking to build a portfolio efficiently?
Yeah, maybe I'll just kind of give a little bit of a framework, and you should add your thoughts onto this too, Alex. But I'd say start with your goal. What are you investing for? And think long and hard about that, because that'll inform many aspects of your strategy, like how much risk should I take? How much illiquidity risk can I have? What types of assets and strategies might I use?
Are you allowed to change your goal?
Absolutely. Well, I mean, we expand and grow and evolve, right? And so I think you have to be adjust as your goals change, right? And as your financial circumstances change too. So whether you have a job or you're out of work or all those kind of things will have an impact on that.
Is there a time frame? So the reason I asked the question is obviously you can change your goal, but if you're changing it all the time, then that makes it really hard to develop a strategy and stick to it. So there's some balance between long term and reasons to actually change the goal.
Yeah, absolutely. Well, and I think it can change as you begin to accumulate more investments. It's actually just a mental trick, but I think a mental trick that can be quite useful for people to think about is you can mentally just kind of break up your portfolio into different types. So you might say, this is my portion of my portfolio, which is there for my protection against, let's say losing my job or whatever might happen in the near end. And so maybe you say, I'm going to set aside something like 2 years worth of my spending and try to keep that in cash. That would be one part of it. And then you can sort of say, well, I have my retirement spending, and I'll think about that. I have my saving that I'm doing for my kids to go to college, and I'm going to invest with a certain time frame that's probably not as long as your retirement time frame. So you can actually kind of break up your portfolio in lots of different ways, and you build to the strategy that kind of matches all the different things you're trying to accomplish, because you're probably not just going to have one goal. That's the other thing to consider here. You're probably going to have more than one goal, and you're trying to accomplish them all simultaneously. And so you're going to have to make some trade-offs, but also I think that idea of kind of breaking them into pieces can also help you to think through, how do I attack this problem, as opposed to just think of it as one, thinking of it as one pool of money, I think can make it difficult to decide what to do.
Step one is make sure you have a goal that's well defined and logical and has a long time horizon. What other suggestions do you have for the average investor?
For anybody who's taxable, I think you got to think about after-tax returns, not pre-tax, and after cost returns too. In addition to that, build an asset allocation as the core of what you're trying to do. That's the most important thing that you want to try to stick to that as much as possible over time. Diversify. And so what that really means is, even for the conservative part of your portfolio, or if you're a very conservative investor, you want to hold a bit of stocks. You just don't hold a lot of stocks. Maybe you hold 10 to 20% of your portfolio in stocks, but not holding any stocks is actually a real gap, and is actually one of the things that you're not truly diversifying if you were to do that. And then, of course, the same goes for the aggressive investor. The aggressive investor should still hold some things that are generally perceived as more safe. I think you should review that strategy on a regular cadence, but try not to make big changes unless the underlying assumptions and the kind of fundamental things that went into how you thought about your asset allocation or your portfolio, if those change, then you can change what you're doing. I would say if prices are moving around, I wouldn't change what you're doing, and try to stick as much to rebalancing that portfolio as you can within things like managing your taxes. And then, try to resist jumping on the bandwagon when there's a hot topic out there. I would say, dig into it, maybe do a little bit. You could always have a small investment that you're sort of saying, I'm going to play with this. But generally, I would say try to avoid making big changes as a consequence of that.
One of the big mistakes that I've observed is everybody knows you're supposed to buy low and sell high. Yet in practice, and even though it sounds counterintuitive, most people buy high and they sell low. And I think it's because there's an extrapolation of the recent past into the distant future. When something is going up, and the faster it goes up, the more you extrapolate that into the future. You want to buy that thing, even though it's high. And the thing that's fallen, you extrapolate that into the future. You think it's going to keep going down, so you want to sell it, even though we know we should be doing the opposite.
Absolutely right. Yeah, and I think it's kind of interesting how people think about stocks and bonds, right? Where when it comes to stocks, most people tend to focus on the price, and when the price goes up, it really makes you want to buy more. Just as you said, and when it goes down, it makes you want to sell it. When realistically, you should actually be doing exactly the opposite. And so bonds are interesting because most people tend to think about bonds in terms of the yield. And thinking about the yield is actually thinking about the expected return. And so people probably behave more like they should when it comes to bonds if they're thinking about them in yield terms. They're going to buy when yields are high and sell when yields are low, as opposed to that tendency you might have when you're thinking about stocks and prices. Even the perspective you take on markets can actually influence the kind of emotions or instincts that you feel with regards to how you should actually react to those things. That's a very interesting piece. I think kind of goes to why psychology is a big part of investing.
So when you were at Bridgewater, a big part of your responsibilities and also your interests, knowing you, it was to assess the economic outlook. There's a lot going on today. Would you share with us your overall macro outlook?
Absolutely. I'll probably give you a very brief overview of this, Alex, and then I think maybe we can talk about a few of the interesting things I would pull out of there. So, this time of year, I'm sure that those listening are probably like me, where you get lots of outlooks for the coming year. This is the time where those are put out. One of the things I really see there is a strong consensus around the picture that frankly seems generally right as a starting point for what the outlook looks like. So if I kind of sketch that case very briefly here, Alex, I'd say the broad case tends to be that inflation has largely been brought under control, which allows central banks to do some degree of easing that'll be supportive of growth over time. And so for the US, what that argues is our U.S. growth has actually been pretty strong, probably a little bit of a weakening of growth in reflection of the recent tightening that's occurred, somewhere in the range of about 2% growth with probably 2 to 3% inflation and a few more cuts on rates by the Fed. When you look around the rest of the world, Europe, actually growth has been quite weak, but easing will probably gradually begin to support growth more going forward amidst a world of inflation being under control. Japan is interesting in that growth is probably likely to pick up, but the BOJ is likely to do some tightening. That's because inflation there has been sustained above their target now for quite a while. And of course, rates have been exceptionally low for a very, very long period of time. So they're thinking about moving back to a more neutral rate of interest rates. China, I think, is one area which I think is very interesting. And it kind of stands out as being in a different cycle here, where they're in many senses flirting with deflation when it comes to the inflation story. So that's very contrary to what's going on in the rest of the world. Their worry is more about deflation. Growth has been weak, has been okay, but kind of weakening, and probably, in many senses, one of the big deals going on there is they've been through a property market bust. And so markets anticipate that they're going to need more stimulation to actually accomplish their growth goals, which seems right. And, I would probably take that and maybe add on to that in many senses, I think for China, what China's really going through is that their economic model, which was good for them during the period where they're developing, is no longer fit for purpose. And what they're really in the midst of dealing is having to revamp their whole economic model. And in particular, they can't rely on exports nearly as much as they have in the past. They're just too big to actually do that. They really can't have that be the main driver of how they actually experience growth. That's a reasonable starting point as a central expectation of what's going to go on, but I think it's far from the whole story. And in many senses, I think that a big part of that story is actually the range around that we might experience. Because today, as we talked about before, there are times where uncertainty is high and at times where uncertainty is low. I think the uncertainty here is pretty high relative to what we've experienced more recently. In that sense, too, Alex, it gives me pause when I see almost everybody saying the same thing when it comes to their outlook. In many senses, what that sort of argues is that even the bears have capitulated here and are no longer trying to make the bear case, and that everybody's on board with everything's going to be great. That tends to be the kind of thing that makes me worry, especially the contrarian in me makes me worry about that. So I would sort of start there, but then a few things that I think might be interesting to talk about is in that vein would be the point here around how non-monetary policy or other forms of policy in the U.S. Represent a big risk at this time. I think inflation is another big topic and actually going to be somewhat related to that how policy evolves in the United States. And then that idea of China and working through the aftermath of their property bust. I think that's a third big thing that present big risks about how things may actually play out relative to that consensus, if you will, that has developed.
The last time I remember consensus like this is just me personally, was back in 2007. And you had a few people concerned about the downside, but there was a lot of perspective and consensus on the good times will continue. And you saw what happened then. You couldn't have a bigger disconnect versus what was priced in.
Absolutely. And of course, we may not be right away. It could be a while, but I think there's good reasons to believe that could be the case. So when I refer to policy, of course, monetary policy has a big influence on economic outcomes and markets over time, and has probably been, through most of our lifetimes, the most important form of policy that matters when you're thinking about economics and markets. But as we go into the Trump presidency here, I think one of the things that's particularly important is that some of the policies that were discussed, at least on the campaign trail, are really about disrupting how things actually operate in the United States in a way that would be very big relative to what you typically think of as the impact of those kind of policies on economic outcomes. And so in particular, of course, the two things are the tariffs and the idea of immigration policy. And so at the end of the day, tariffs, if we were to experience them, one of the things that could really tip China over the edge here would be significant tariffs. China is very vulnerable to that point, and they're very dependent on export growth as a driver of the economic outcomes they're experiencing. So they're actually very, very exposed to that particular outcome. And of course, even for the United States, you'd worry about the inflationary consequences of that. The second point that I would talk about is immigration policy, and that it's a very hot topic almost everywhere around the world where there has been large degrees of immigration. Totally understandable why that is the case. At the same time, you'd also say what we're facing from a secular perspective is a declining working age population. We have an aging population as the baby boomers actually move into retirement, and a shrinking population that actually works. What that really presents then is immigration is one of the ways that has actually kind of kept the growth rate up by having more people out there to do that work through immigration. And of course, the other influence I didn't mention, that I should mention, is that birth rates have really slowed down throughout much of the world, even including areas of the emerging world. And so those birth rates are now below replacement, where the population will shrink over time. So Japan in particular is an example of that, where they have really aged so much and their birth rate is so low that zero growth is about what you'd probably expect for Japan over time. That's just because of the growth rate of productivity on top of a negative population growth. So those two things add up to saying no growth is actually what you'd expect there. So in the United States, it's not that bad, but it's definitely slowing, which then means that this concept that we're always growing is increasingly challenged as you look forward. But also what it argues is it raises some risk of inflation. So when I think about inflation, to me, there's an underlying thing that would sort of say, in many senses, I think that'll be a really interesting question here, but inflation may potentially be more sticky than people really realize, and not that last mile of getting inflation down to 2% may be pretty hard. That's even before you take into account policies that could be very inflationary. So the tariffs and immigration, doing an awful lot of deportations, and even beyond that, just kind of discouraging immigration in general. Those things could actually be really things that help to cause inflation to go back up again. So I think that's a real risk, especially where markets are today. That's somewhat what the bond market is already responding to, and that stocks are going to have to respond if bond yields go up. That's one of the things that really could tip the stock market over here as we look forward.
Let me ask you about U.S. stocks. Obviously, they perform exceptionally well for a long period of time. And typically, when you look at this from the science side, you'd say mean reversion will ultimately prevail and lead to underperformance in the future. Do you think that this time may be different for U.S. stocks?
I mean, largely, I don't believe that it is, Alex. It doesn't mean that in the short term that's going to happen, as we've said before, but I do think when you start to look over longer timeframes, 10-year timeframes, it's pretty likely that the U.S. will underperform. One of the kind of newsletters that I like to read is from Howard Marks at Oaktree Capital. You probably read this as well, but he had, in his most recent piece, he'd borrowed a chart from JP Morgan, which was looking at starting levels of PEs and comparing them to subsequent 10-year returns. And so when he marked where the U.S. is today relative to that, current PEs would tend to argue for very low, maybe even slightly negative returns over a 10-year time frame if you look at that historically. And so, I generally believe that that's probably right, and that whether or not it's as low as what I'm describing, it could easily be a bit better than that for sure. It could also be worse. But, as you look at that, I think that that's unlikely that this time is so different, because if you look back over the more than 100 years or so of where the stock market in the U.S. is, we have evidence of what it looks like. There's lots of technological innovations that have come along in that time frame, and many of them have been very big deals. And so there's a cycle it takes typically to absorb those. And, when I think about this cycle, I think it's probably much more likely that it's not different than that it's different, if I was to sort of express that probabilistically.
One of the challenges with mean reversion is if you're looking at over a 10-year period, you could be 100% right that the returns for U.S. stocks could be low over 10 years, but they may be great for 5 years. And then they could be terrible for 5 years. And you look back and say that we were exactly right, but the path really matters. And the path is very difficult to predict.
Right, which is why I don't think you should make huge changes. Like, you should make adjustments at the margin, kind of set limits that you might feel comfortable with. But in general, you don't want to get all out, or you don't want to go all in. That kind of stuff is generally not where you want to live.
You also talked about the risk of inflation. And I assume what you mean there is there's probably a potential asymmetry with inflation going up a lot versus going down a lot. How should investors think about navigating the risk of inflation and potential inflationary policies?
Maybe I'll hit on a few things behind that first, try to explain that a little bit more than I did. So if you go back and you think about most people's investing lifetimes, for the last 40 years, we've been in an era where inflation has generally been declining or low and stable. And so that began in the 1980s with very tight monetary policy, as Volcker in particular tried to reverse the inflationary trends of the 1970s. And that tight monetary policy lasted into the 1990s. But by the 1990s, what actually picked up was an enormous wave of globalization. And so the economies around the world really opened up to the ability to produce almost anywhere you wanted to. And that created this global competition for labor. First with East Asia, Eastern Europe, Latin America in the 1990s. And then you got an enormous boost when China really joined the WTO in the early 2000s. So that wave of disinflation has been going on first from monetary policy driven to then globalization through the 1990s into the 2000s. And so that's a huge secular trend, which has really helped to keep inflation under wraps, I think, through much of that period. And in particular, by having the global competition for labor itself. So as you look at these trends we're talking about, the policy changes that the Trump administration is discussing, in many senses, that's more of a deglobalization. So it's a reversal of this process, which has helped to keep inflation down for a long period of time. We may see the opposite of that. You go back to more nationalistic kind of policies. Everybody has to have their own versions of all these major industries. That's going to actually lead to a lot more spending and in essence, kind of a much less efficient overall system. So in many senses, that's a big change in the inflationary trend from disinflation to potentially inflationary. You lay that on top of aging demographics, which we already talked about. I think that's also a very big deal here as we go into this realm now where growth itself is slowing as an underlying kind of core driver, because population growth is one of the things that sets your long-term trend growth. That's slowing down in ways that are actually leading to lower and lower growth. So as these dynamics kind of come together, they intersect with a third thing that I would really kind of highlight, which is a potential, I would say, more so than something that's clearly inflationary, but that is debt dynamics. And what I mean by that is we're entering into dealing with these challenges of deglobalization and aging demographics at the same time that the countries around the world are already relatively highly burdened by debt. And so that's true not just of the United States. It's very true of Europe. It's true of Japan. It's even true of China today when you look at this. And so how you're going to address these issues of aging populations. And then, of course, there's other things that probably argue for spending, like adapting to climate change, defense spending in the face of an increasingly fractured world. Those are all things that are kind of secularly probably going to put pressure on debts. And as you think about how you try to deal with that, one of the outcomes you tend to get throughout history is because if you don't actually keep monetary policy somewhat on the easy side, growth can be quite weak in the face of debt, of very high debts and typically higher interest rates. So you tend to run monetary policy a little easy, which encourages inflation in the face of dealing with those things and dealing with the debt issues. So, there's a bunch of these things which look like they could offer the potential for more of a secular turn in inflation here. And by no means is that guaranteed. I'm not trying to say this is absolutely going to happen. But at the same time, at the very least, I would say you can't rely on as much what has happened to returns in the last 40 years to then think about the next 40 years, let's say. Instead, I would argue you want to be a little bit more balanced to things like inflation, recognizing that stocks and government bonds, nominal government bonds, have benefited enormously from that disinflationary trend and don't do that well if you were to have the opposite of that. So that's where things like inflation-linked securities in the government bond markets, some commodities, real estate, I would definitely be paying some attention to those within your asset allocation today, just as a part of establishing something that might be a good long-term approach to dealing with the prospect of the potential for inflation to actually reverse.
So if we kind of sum up everything we've talked about today, we started with be more diversified because there's a lot of value in that. And in a world where uncertainties increased, which I think you made a very compelling case why that's the case, including on the inflation side, it makes sense to be more diversified. And because we haven't had high inflation, except for a short bout post-COVID of high inflation for 4 decades, that's one of the missing pieces in portfolios to become more diversified. And so it kind of makes sense to not only be more diversified, but also to look at inflation hedge assets as a way to achieve that diversification, particularly given the shift in secular trends that you just walked us through.
I think that's right, Alex. I appreciate the summary.
So let me close with another hot topic today, and maybe it has some impact on inflation as well. What do you view to be the influence of AI on markets, investing, and even inflation longer term?
Yeah, it is an interesting one in that in some senses it could, for example, take some of the pressure off the shrinking labor force by requiring less people to accomplish things. So it's a possibility that that is the case. At this point, I would say, it's very hard to know. I don't particularly pretend to have any into special insight into how AI will actually change our world, if you will. There's been so much discussion of that already by others who are probably much more expert in that area. But when I think about that, my guess is that it's probably going to be a bit underwhelming in the near term, but when you start to go out to longer term time frames, like the next 10 years, it'll have a big impact. Then we look back and say, wow, I can't believe how big that was as a change in how things actually operate. And I think that's probably true of the investing side of it and how we think about investing and the tools we use to invest. But even more so, Alex, I would say, if you're invested in stocks and companies, I think what you're going to see is a lot of where that is going to be taken advantage of is in that area. And so just by having a broad exposure to the stock market, you're going to have winners and losers, but you're going to have a lot of exposure to people trying to put that into practice in ways that create better productivity and actually help to address some of these challenges. So I don't think you necessarily need to run out and do something totally different to actually deal with this. It's much like other things that have occurred that you're going to see that actually play out in the existing kind of companies that are already out there. And, maybe more so than what happened with the tech boom, it's the largest companies in many senses that are really pushing the hardest in this area. So it's not like being only in small cap is where you have to be to protect yourself. You've got a lot of very large companies who are pursuing this because they do see a lot of potential for it. So, your broad stock market exposure seems pretty likely to benefit from that.
The most reasonable analogy I've seen to this AI boom is the internet boom of the late 90s. And I remember very clearly at the time, people thought the internet was going to change the world, and the NASDAQ went to crazy levels, and we saw what happened after that. And guess what? The internet did change the world, and it gave birth to other technologies like AI and so on. And that was hard to envision at the time. And it took longer than I think many expected. And we could see the same thing again. It's hard to know. And the part that I'm most curious about is, what is the next level up from there? We can kind of see the path for AI, but what does that lead to? What other new innovations does it lead to? And that's just a continuation of, the evolution we've seen in the last 100+ years with new technologies. It's easy to get excited up front, and a lot of that can get reflected in prices, but oftentimes these things take time to play out.
Absolutely right. I'm reminded of something that I heard Neil deGrasse Tyson say at one point, which was he was just talking about that people tend to underestimate the impact of compounding with regards to innovations that we've made over time. And that today's innovations are really building on 100 years of a growing population that's really figured out so many more things. And today's population is able to figure out many more things than we were able to figure out 10 years ago even. So, and that's all compounding on itself in a way that is driving the pace of change that we experience around us. And so that happens in the economy just as much as it happens in markets. And it's easy to lose track of that, but that's where it tends to lead to bigger changes happen over long periods of time. Yeah, but people maybe overestimate the short-term impacts of those things. I think that's absolutely right.
Well, Jeff, this has been a fascinating conversation. I've enjoyed it. I've learned a lot, and I hope our listeners did as well. Thank you for joining us.
Thank you, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.